was 9:42 a.m. on a Thursday when Tokyo's bond desk exploded into chaos. A single Bloomberg tick, Japan dumping $1.7 trillion of U.S. treasuries, hit trading terminals like a coded bomb. In that heartbeat, keyboards thundered, algorithms flared, and a veteran trader watched his screen bleed red. Across oceans, London and New York trading floors erupted as models triggered panic alerts and portfolios crumbled. This wasn't a mistake, it was a meticulously timed digital shockwave designed to implode decades of assumed financial loyalty without a single press conference. So who gave the order? Why now? And what happens when China follows next? Stay tuned, because while Tokyo's architects of upheaval savored the fallout, global markets weren't just reacting, they were unraveling. And the first sign of collapse came not from headlines, but from the Treasury yield itself. 47 million retirement accounts evaporated, up to 20% of their value in just 3 weeks. Pension funds scrambled to hedge, deploying derivatives normally reserved for crises twice their scale. A prominent portfolio manager's internal memo leaked to the press read, "This is not a correction. This is systemic failure." As rates soared, mortgage applications plummeted. First-time buyers found themselves locked out of financing, while adjustable-rate homeowners watched monthly payments balloon overnight. Corporate treasurers, who had parked cash in treasuries for decades, now flagged losses in the hundreds of millions. Institutional investors scrambled to recalibrate entire balance sheets, dumping equities in a frantic bid for liquidity. Somehow, trillions of dollars in repositioned assets created a feedback loop that sent stocks tumbling even faster than bonds. While Wall Street scrambled, families across Ohio and Oklahoma felt an even more personal shock: the grocery line crisis. In Dayton, Ohio, Maria stared at her shopping cart in disbelief. Milk had jumped 30%, eggs 45%, and bread 20%. As a single mother of 3, she kept 2 years of grocery receipts taped to her fridge. Today's total was nearly $50 more than last month. With groceries gobbling 90% of her take-home pay, Maria rationed peanut butter sandwiches for her children. The dollar tsunami. When the 10-year Treasury rate jumped from 4% to 6.2% in under 24 hours, algorithms screamed. In Manhattan's bond halls, traders' screens exploded with red arrows, and the usual hum of chatter gave way to urgent shouts. Tick by tick, the yield curve steepened, turning safe government debt into suddenly toxic paper. According to a Fidelity report, the dollar's weakening against the yen, plunging 15% in just 2 weeks, sent import prices soaring. Local food banks reported lineups twice as long as in the previous winter, while cashiers whispered about the highest price hikes they had ever rung up. For moms like Maria, inflation was no abstract number. It was deciding between diapers and dinner. Economists agreed this was no mere blip. Consumer Price Index data published that week showed headline inflation at 8.3%, the worst since 1979. But numbers on a chart did not capture the panic of grocery aisles or the dread of empty pantries in small-town America. And as grocery bills climbed, the White House was drafting 100% tariffs, its most aggressive move yet. The junior partner betrayal. How do you repay decades of alliance? By slapping your closest friend with electric vehicle taxes. Under President Donald Trump's administration, Washington imposed 25% tariffs on Japanese imports. Toyota, Honda, Nissan, framed as shielding Tesla, General Motors, and Ford. But to Tokyo, it felt like a slap at national pride. Since the 1970s, the United States and Japan had woven security and trade treaties into the fabric of the Pacific Alliance. Electric vehicle innovation, Toyota's Prius and Nissan's Leaf, were celebrated as joint triumphs, not threats. Yet in January 2025, a leaked embassy cable revealed Tokyo envoys privately warned U.S. trade negotiators, "Treat our technology as a pawn, and we will respond with equivalent force." That force arrived not in steel or cars, but in finance. As Tokyo's bankers monitored Washington's policy memo, they quietly drafted the order to liquidate $1.7 trillion of United States debt. The move was framed as strategic recalibration, but it was retaliation pure and simple. A message that economic partnership could be weaponized. That's why we dug through leaked embassy cables, trade memos, and financial data to connect what really happened behind that trillion-dollar sell-off. Now you see how a silent alliance turned into a global economic weapon without firing a single shot. If that saved you hours of research, hit subscribe. That's all we ask. Now, as finance became the weapon, Asia's secret alliance sprang to life. 100% hammer. With the stroke of a pen, Washington transformed decades of partnership into a field of shattered factory. Under Section 301 of the Trade Act of 1974, President Donald Trump's administration declared 100% tariffs on virtually every Japanese import. By the time the Federal Register notice went live, Japanese automakers, electronics giants, and precision machinery producers faced duties equal to their entire invoice price. Toyota Corporation's chief financial officer was said to have stared at the announcement in disbelief, tapping out a terse email. "We have never anticipated anything of this magnitude. Production lines must pause." In Detroit, the United Automobile Workers Union swiftly called emergency talks, warning that hundreds of thousands of jobs were now at risk. Across the Midwest, assembly line monitors reported canceled parts shipments, while port authorities in Los Angeles and Long Beach halted container offloads, uncertain whether the duties would be collected or rejected. Dealers in New York and Chicago began canceling orders, fearing that even popular models like the Prius would arrive with crippling add-on fees. Corporate boardrooms buzzed with dire predictions, losses measured in tens of billions of US dollars, possible bankruptcies, factories shuttered indefinitely. Meanwhile, text alerts buzzed in the Japanese embassy in Washington. Senior envoys were summoned to the U.S. Trade Representative's office, where they were lectured on national security rhetoric. To Tokyo's delegates, this felt like a personal betrayal, an affront not only to their economic interests, but to 70-plus years of military and diplomatic alliance, dating back to the Treaty of San Francisco in 1951. No longer a mere policy dispute, this tariff edict felt like a declaration of economic war. Yet as Detroit's furnaces cooled and corporate memos piled up, Japan's strategists were quietly readying their own counterstrike. Asia's covert alliance. Under the cloak of darkness, Asia's finance ministers convened in an encrypted video conference that would reshape global liquidity. Japan's finance minister, seated before a wall of digital bond yield graphs, unveiled a network of currency swap lines totaling 200 billion US dollars in Indian yen arrangements and 150 billion in Korean yen facilities. These bilateral agreements functioned as automatic liquidity backstop, an implicit rejection of dependence on United States treasuries. An International Monetary Fund advisor later described the deal as years in the making, yet executed in mere days. Swap line activation protocols, which ordinarily require months of legal review, were fast-tracked through emergency authorizations. By the time Tokyo markets opened, Bangkok, Jakarta, and Kuala Lumpur had signed on, pledging their own local currency facility. The pact created a safety net for Asian banks that could draw on the collective firepower of these lines if U.S. bond markets froze up. In Hong Kong trading floors, whispers spread among proprietary desks that this alliance represented Asia's version of the Federal Reserve. Overnight, the psychological underpinning of dollar dominance cracked. If U.S. debt could be sidestepped by coordinated local currency tools, the dollar's exclusive role as safe haven asset was in jeopardy. Traders in Mumbai and Seoul reweighted portfolios, lightening treasury holdings and increasing allocations to local government securities. With Asia's financial fortress rising, a new theater of retaliation opened in Europe, the French wine siege. A Bordeaux vintner called it economic waterboarding, recalled one European Union trade official. In Brussels, the EU's executive arm announced 200% retaliatory duties on American whiskey, bourbon, and wine. Where exports had routinely flowed at a rate of 6 billion euros per year, those shipments now faced prohibitive levies. Cargoes destined for Marseille and Rotterdam were rerouted back across the Atlantic, containers idling at port docks like forgotten relics. Chateau owners in the Medoc region watched as buyer confirmations vanished. Sommeliers reported entire wine bars in Paris removing American spirits overnight. At a press briefing in Strasbourg, the EU Trade Commissioner framed the measure as a calibrated response to economic blackmail by the United States. She argued that defending European artisanal industries was a matter of cultural heritage as much as commercial necessity. Back in London, importers faced the dilemma of either absorbing steep costs or abandoning the market entirely. Small batch distillers described canceled orders as catastrophic, warning that 2 years of production would need to find new markets beyond the Atlantic. Investors in French wineries, long drawn by stable export revenues, began reallocating capital into Asia and Latin America. Even the typically staid commodity traders chuckled at the irony. Washington had weaponized trade, only to have Europe return fire with its own barrel-chested volley. Yet north of the St. Lawrence River, Canada prepared a retaliation of its own. one that extended beyond trade and into the Arctic skies. Canada's Northern Gambit. In Ottawa, top-secret defense briefings outlined a $6 billion Canadian purchase of Australian long-range radar systems. These mobile units could scan 3,000 kilometers of Arctic airspace, detecting threats without relying on U.S. defense networks. The announcement came alongside a quiet sell-off of $37 billion in Canadian Treasury holding, reallocating reserves into euros, renminbi, and yen. Officials in Nunavut hailed the radar move as a boost to sovereignty, proof that Canada would no longer be sidelined in northern defense planning. Meanwhile, analysts in Toronto tracked the bond shift's effect on the Canadian dollar, which spiked briefly before stabilizing. Pension funds were discreetly advised to pivot toward domestic bonds and European credit. In Yellowknife, Indigenous leaders welcomed improved rescue capabilities, but warned of military escalation on ancestral land. In Ottawa, diplomats drafted talking points for G7 and NATO, this time demanding Arctic representation independent of Washington. As alliances cooled and the northern skies hardened into a fortress, the next conflict would unfold, not on runways, but at home, where everyday Americans braced for the reckoning to come. Inflation's true face. Across the Midwest, the numbers on paper had started to feel like numbers on fire. But in Detroit, they had a name: Ana Martinez. Ana Martinez didn't need a headline to know the economy was broken. Her grocery bill told the whole story. A Detroit school teacher and single mom, Anna watched her weekly food costs jump by over $300 compared to the year before. Milk, bread, eggs, basic staples now felt like luxuries. And she wasn't splurging, she was surviving. Across the country, millions were facing the same math. In Toledo, Tulsa, and Grand Rapids, families skipped meals, canceled doctor visits, and pulled kids from daycare just to keep the lights on. The Bureau of Labor Statistics confirmed the crisis. 10% food inflation, 12% on energy, and core inflation stuck at 6%. But none of that captured the daily squeeze, the dread of payday disappearing in 48 hours. Local support systems buckled, food banks overflowed, churches ran emergency kitchens 7 nights a week, city councils fielded desperate pleas for rent caps, heating relief, and utility forgiveness. Washington promised tariffs would fix everything, but nothing came. So Anna picked up a second job sewing cloth masks at night, and still fell behind. When politics offered no help, something else kicked in: anger. And that's when workers across the country finally said enough was enough. The Great Worker Revolt, from auto workers in Detroit to steel workers in Birmingham. 5 million Americans walked off the job in history's largest labor uprising since 1934. What began as a handful of United Automobile workers striking at a General Motors plant in Flint quickly spread like wildfire. Within days, steel mills in Alabama, paper factories in Wisconsin, and public school teachers in Pennsylvania joined the exodus. Union leaders cited broken promises. Tariff-driven booms that never materialized, combined with crushing living costs, spurred the revolt. In Michigan's capital, Lansing, picket lines stretched for miles, strike tokens circulated on social media, and union halls overflowed with meeting. Local media reported that union membership had jumped 30% in the previous month alone. Behind the scenes, union negotiators drafted emergency negotiation requests, threatening walkouts if federal policy did not course correct. In Birmingham, steel workers' chants echoed through factories, while in Philadelphia, teacher rallies blocked downtown traffic for hours. This solidarity transcended industry, as one steelworker's sign, "We built this nation, now watch us break your lines," became a viral emblem of defiance. The uprising forced white-collar offices to shut down as support services faltered. Grocery stores struggled with staffing shortages. Mass transit faced sudden driver walk-offs. Even Washington could not ignore the scale. Emergency summits convened at the White House to address worker unrest. And in those towers, CEOs confronted their own existential choice: stand by the president or abandon ship. Chief executives versus the commander-in-chief. No executive jet carried them to Mar-a-Lago. Capital flights carried them away, quipped one Wall Street insider. Corporate political action committees saw donations to the president's campaign plunge 45% over 6 weeks. A leaked memo from a leading asset management firm warned that continued policy volatility posed an unquantifiable risk. Chief financial officers at Fortune 500 companies held emergency conference calls. One senior banking officer confided, "We no longer see the White House as an anchor, we see it as a storm." Hedge fund managers executed liquidity stress tests, drawing down positions in politically sensitive sectors. Campaign fund managers reported record-high refund requests, Donors demanded contributions returned and redirected to nonpartisan stability funds. Business schools noted a spike in discussions about policy risk in their executive education programs. The Business Roundtable debated public statements. Some chief executive officers issued letters calling for bipartisanship, while others quietly shifted headquarters, planning away from Washington. Private contributions to political action committees favored moderate candidates, promising to stabilize trade policy. This exodus of corporate support left the president isolated. Polling data showed favorability sliding in key swing states as headlines recounted boardroom defections. The executive office scrambled to reassure business leaders, issuing impromptu White House briefings emphasizing open channels of communication. Yet those overtures felt too little, too late. As CEOs abandoned ship, finance ministers across continents quietly wrote the death warrant of the dollar's dominance. The birth of a new currency on a slip of rice paper at the G20 summit, Asia and Eurasia sketched the blueprint for a new global reserve basket. Delegates from Japan, China, Russia, India, and key Southeast Asian nations convened in Riyadh to sign a communique proposing a composite unit of account. The draft allocated 30% weight to the Chinese renminbi, 20% to the Japanese yen, 15% to the Russian ruble, 10% to the Indian rupee, and the remaining 25% divided among gold, energy bonds, and pan-regional development funds. International Monetary Fund forecast projected the dollar's share of global reserves sliding below 50% by the end of 2027, the lowest since the Bretton Woods era began. Central banks from Brazil to the European Central Bank quietly prepared to adjust their reserve hedging algorithms. One senior European central banker was overheard saying, "We're witnessing the slow-motion collapse of what was once unassailable." Petrochemicals trading in OPEC meetings began to reference alternative pricing benchmarks. In Singapore and Dubai, a new digital clearinghouse for local currency settlement launched, bypassing SWIFT and Fedwire rails. Commodity exchanges in Shanghai and Moscow reported negotiation of 12-month forward contracts denominated in the new basket. Back home, American savers logged in to Dashboard Alert, realizing their Federal Reserve's policy statements no longer set world interest rates unilaterally. Portfolios once anchored in U.S. Treasuries reeled as the implied risk premium on dollars climbed. Financial advisors scrambled to craft new global resilience funds, explicitly excluding dollar-only assets. Thus concluded the birth pangs of a multipolar monetary order. As the old guard faltered, a fresh epoch unfurled, one where no single currency could claim a monopoly on trust. The geopolitical blueprint. Imagine a world where oil is priced in renminbi and defense pacts exclude Washington. Welcome to 2026. Across conference rooms from Riyadh to Jakarta, finance ministers compared the old dollar-centric map with a new multipolar grid. The post-World War II Bretton Woods framework, underpinned by U.S. military bases and dollar reserve privileges, gave way to a network of regional blocs. ASEAN nations extended local currency trade agreements worth hundreds of billions of dollars. The European Union signaled readiness to settle more commerce in yuan and yen, while Russia and India formalized a ruble-rupee swap mechanism, securing cross-border funding. Energy contracts in OPEC quietly referenced alternative pricing baskets, combining gold, technology bonds, and currency swap credits. In recalibration of global benchmarks. No public declaration, just updated pricing sheets. Analysts at Stratfor explained that this blueprint codified long gestating trends. Nations chafed under dollar volatility, but only when Japan pulled the first public lever did others feel emboldened. Infrastructure financing in Southeast Asia began bypassing the World Bank, flowing instead through an Asian Development Fund, backed by both Japanese and Chinese contributions. European corporations preferring Euroclear settlement to Fedwire added momentum. The International Monetary Fund updated its quota system to reflect new reserve weights. Central bankers from Brazil to South Africa adjusted their reserve hedging algorithms, preparing for a world in which no single currency reigned supreme. Policy planners in capitals realized that dependence on U.S. economic policy was a vulnerability. Once a sanctuary, the dollar had become a potential source of instability. As the new map was drawn, American savers scrambled for guidance. What portfolio moves could preserve wealth when the old safety nets have holes? Portfolio Survival Guide. If your retirement plan still hangs on U.S. Treasuries, it's time for a wake-up call. In this era of fractured alliances and reserve diversification, true resilience demands creative diversification. First, allocate 10% of fixed income holdings to ASEAN infrastructure funds. Projects in Vietnam's energy grid, Indonesia's toll roads, and the Philippines' port expansions now receive direct financing in local currencies, offering yields 200 basis points above comparable U.S. debt and insulation from dollar volatility. Second, earmark another 10% to European investment-grade corporate bonds denominated in euros or sterling. Large multinational issuers, Airbus, Siemens, Unilever, have begun issuing under the new reserve basket guidelines, providing stable coupons and deep secondary markets. Third, hedge currency risk by pairing existing dollar holdings with gold-backed exchange-traded products. Gold's universal safe haven status shines brightest when fiat systems wobble. Combine physical-backed ETFs with periodic rebalancing to lock in gains. Case study: a 55-year-old retiree in Minneapolis rebalanced $50,000 into a Vietnamese government bond fund, locking in a 6% yield and diversifying currency exposure. A certified financial planner at the National Association of Personal Financial Advisors recommends staggering maturities in 3-year increments to avoid refinancing risk and using forward contracts sparingly to cap downside. Across Wall Street, wealth managers label such allocations under global resilience portfolios, explicitly excluding dollar-only assets. Yet, even the most bulletproof portfolio can be jolted by politics. How will the looming election decide which policies will govern the next financial era? Washington's election earthquake. Polls shifted 40 points in key swing states as economic fallout eclipsed every other issue. With Midwest unemployment nearing 8% and consumer prices still elevated, candidates on both sides scrambled for credible recovery plans. 538 updated electoral map showed Michigan, Pennsylvania, and Wisconsin flipping from safe to toss-up within a fortnight of the bond sell-off. White House strategists drafted emergency briefings titled Economic Stabilization or Political Oblivion. Behind closed doors, Republican and Democratic advisors dissected granular voter sentiment on inflation, job security, and trade policy. Town hall footage from small-town Ohio featured tearful pleas for mortgage relief and healthcare subsidies. A leaked memo from a leading super PAC warned failure to pivot from hardline tariff rhetoric will hand control of both chambers to the opposition. Meanwhile, independent candidates preaching fiscal sanity gained traction online, drawing support from 5 to 10% of likely voters in early polls. Major television networks framed the contest as a referendum on survival. Whose economic doctrine could steer the country through stagflation, supply chain dislocation, and severed alliances? Control of the Senate and the authority to confirm Federal Reserve governors hung in the balance. Pundits debated whether a slim majority could enact sweeping fiscal reforms, cap national debt to GDP ratios, or renegotiate currency swap agreements. As campaign ads shifted from social themes to utility costs and debt ceilings, the electorate recognized that the next administration would define not only domestic policy, but international financial order. With Election Day looming, one question dominated every conversation. In a world without guaranteed dollar backing, who truly owns your financial future? The new American question. The answer lies with you. Active citizenry at the core of economic sovereignty. First, engage in local town hall meetings to advocate for monetary transparency legislation, limiting executive privilege over backdoor currency swap accords. In February 2026, the first Citizens for Fiscal Clarity Forum in Des Moines drew 2,000 attendees demanding open audit rights for foreign reserve holdings. Second, support bills to cap the national debt to gross domestic product ratio at 80%, requiring automatic spending cuts or revenue increases when thresholds are breached. States like Pennsylvania and California have already introduced similar measures for their budgets, citing fiscal prudence amid revenue uncertainty. Third, diversify personal savings by channeling a portion into community credit unions and local development banks. Unlike large institutions, these entities invest directly in regional small business loans and infrastructure, fortifying local economies and mitigating exposure to global currency swings. Across the nation, from diners in rural Iowa to co-working hubs in Austin, Americans are forming citizen finance committees to monitor regional economic health and lobby for reform. Podcasts on money for the people attract tens of thousands of listeners, teaching listeners how to protect their families from systemic shocks. High school civic education programs now include modules on central banking and reserve baskets, ensuring the next generation grasps both promise and peril of digital currencies and multipolar finance. The new order demands active participation. Financial loyalty can no longer be assumed. It must be earned daily through transparency, accountability, and civic engagement. As history turns this page, every citizen holds a stake in charting the future. How will you earn yours? Join the conversation. What steps will you take to safeguard your finances in this unfolding multipolar world? Share your thoughts and strategies in the comments below. Your perspective could spark the next great discussion. Thank you very much.